Hey everybody, how are you doing? Hope you're good. In today's video, we're going to look over what are candlesticks and what are their importance in your trading, how you can use them to your advantage in trading so that you can actually get better results. If that sounds interesting, stick with us until the end. Share with a few friends that you believe the video will be of help to them. And without further ado, let's get right into it. Okay, cool. Now, what are candlesticks? Candlesticks, from the very definition, it's a graphical representation of price movement for a given period of time, right? So you can see a candlestick is a graphical representations of price movements of a given period of time. So in every given period of time, so for instance, here in the charts, you see we have different time frames, and each time frames has their own candlestick. So for instance, here we're on the 1 hour time frame on the DXY. Each candlestick, for instance, this candlestick here, is a graphical representation of the price movement within the last hour because we're in the 1 hour time frame. So if we go in the 4 hours, this is the graphical representation of the price movement within the last 4 hours. If we go on the daily, same applies. This is the graphical representation of price movement on the DXY, or the US dollar currency index, yesterday or the previous day, right? So candlesticks, what they merely present is the graphical representation of movements of the price within that specific time period, right? Now, they're normally formed by given the opening price and, the closing price, the high and the low, all of these which are very important in your trading. So for instance, here are two graphical representations of candlesticks, the green one being the bullish and the red one being bearish. So when I say bearish and bullish, I mean when prices are moving from they're moving from down going up, this is what we call or consider a bullish move. So if prices, for instance, this candlestick right here, you see prices opened low and then pushed all the way and then they closed here. This is a bullish candlestick because prices are coming from down, they're going up. Now, if prices are coming from vice versa of that, they're starting up, going down, this is what we consider a bearish movement. Now, if a candle does a similar movement, so for instance, prices start up and then they close down, as this candle did right here, this is what we consider a bearish candlestick, right? Okay. Now, coming back here to the graphical representations, candlesticks have a lot of information that they can present. Not only do they offer the open and close prices, but they also offer the highs and the lows, which isn't offered by many other graphical representations out there, such as line charts, which they only offer the close price. But with the candlestick, you can actually get the open, the close, the high, and the low. So it gives you much more information on what you need to know on what happened on that specific time period, whether it's an hour, 4 hours, or daily, so that you can actually know what is most likely to happen in the near future within that specific time period, right? Now, coming back to the charts here. So if a candlestick opens low and then it closes high, this is a bullish candlestick, as we just said. And if it opens high and it closes low, this is a bearish candlestick. And this right here, where there's the body, we call this a body, where there is, actual data. And these like lines up here, we call them the wicks, right? We call them the wicks, or some other people call them shadows, as prices reached, but then they were rejected, right? So for instance, if you see here, for instance, in this bullish candlestick, so if prices started, let's say, opened here and then closed here, but you see there's a wick up here, what this means is that prices at a specific given time period in that time range, so either if it's a daily time frame within the day, there was a time where prices reached up here, but then they were rejected and then closed here. So this shadow, or this what we so-called wick, just indicates that prices at a given period of time reached somewhere here, but then they were rejected, which is a very crucial piece of information. So for instance, if it's a large wick, like for instance, let's go to the charts so that we can actually notice this. So for instance, if it's a large wick, let's look for a wick. Okay, so right here. So you see here, we see these candles leave wicks up here. So all of these indicates rejection from the upside. Now we get this information with candlesticks, but if we are using a line chart, look at what happens. We don't see what happened up here. So all we know is that, okay, prices came here, bounced, okay, this is continuing to go down. But this is the daily, so that means the daily closed here, right? It shows the daily closed here, but you don't get the information that prices at a specific point reached up here and then was rejected. We don't get that info. So it's a luxury that we can only get with candlesticks, that you can actually see that prices pissed up here and then was rejected. So it actually gives you a sense that, okay, if prices were rejected from up here, that means there's a very big probability that prices will keep on pushing lower, which it did, right? So it just gives you much more information so that you can actually process the info better, rather than line sticks and, you know, other graphical representations of it. Now, with candlesticks, I believe there are a couple of things that you need to actually know that will actually make your trading easier, right? Now, for instance, with candlesticks, after knowing like this maybe is a bearish candlestick, this is a bullish candlestick, that's well and good, nice. So that's the first thing that you need to know. If you look at a candlestick, you need to know if it's a bearish or bullish candlestick, so that you can actually know which direction the candlestick is heading. If it's actually starting from a higher price to go to a lower price, that's a bearish. If it's starting from a low price going to a higher price, that's a bullish candlestick. It will actually give you the sense of direction of where prices are heading to, which is cool. And then after knowing that, there's another thing that you need to actually understand with the candlesticks. Like, it's how to read momentum. Because yes, prices may be going high, prices may be pushing higher, but how strong are they? So for instance, look at this thing right here. So let's get back first to the ebook, and then we'll get back to that. Okay, so those are the candles, how to determine momentum, right? Now, unlike the popular belief, momentum is very easy to determine while you're reading when you're looking at the candlesticks. So it's just that the bigger the candlestick, the higher the momentum. The smaller the candlesticks, the smaller the momentum. And when we say momentum, what is momentum? What does momentum mean? Momentum means volume, right? So for instance, you can see here, we had a bearish candlestick and then we had a bullish candlestick. This is a strong bearish candlestick, no doubt. We can obviously understand it's a very strong bearish candlestick. But once this bullish candlestick kicked in, we understood like, okay, the bulls might be taking over. But why is that? It's because this bullish candlestick right here is stronger than this bearish candlestick. But how do you know it's stronger? It's because of the size. Look at the size. The size of this bullish candlestick is much bigger than this bearish candlestick. So that means this is stronger than this. All right, no doubt this is a strong candlestick, but this is stronger. It has more volume, it has more momentum. So that means prices have a high possibility of going higher or keep on being bullish, because the bullish candlestick is stronger than this bearish candlestick. Same applies here. This candlestick is a bullish candlestick. It's strong, no doubt, but the bearish candlestick came out stronger. So this indicated that the bears might be taking over because they are much more stronger than the bullish right now. And that's what happened. You can see prices just fell. Here, same thing happened. Prices kept on pushing higher. So you being able to know the momentum gives you a very big chance of knowing what's going to happen next, most likely because of the momentum in the market. You'll have that understanding of who's really in control of the market right now, right? Now, for instance, if you look at here, look at this structure right here be formed. right? Prices came here with this bullish candlestick, another bullish candlestick, another bullish, another bullish, another bullish, and then a doji, bearish, bullish, bearish, doji, bullish, and whatever. Prices kept on pushing lower. But look at this transformation here. Look at this momentum. So it started off strong, a little bit. You can see how it's approaching this resistance structure, how it's becoming weaker, right? How it's becoming weaker. And then after it reached here, it formed like it has no volume. It has no momentum. As you can see, it's a very small candlestick, right? Now, after that, what happened? Prices just started going lower. Prices couldn't push higher than this. They tried, but then they were rejected. Prices kept on pushing lower. So that's the importance of reading the momentum. You can understand like, okay, prices are approaching a sensitive area, and you can see it doesn't have that much momentum due to the candlestick sizes. And due to this, it's a great indication that prices might push lower because they don't have the strength to push higher, right? So just knowing how to read that momentum can put you at a better place on how to analyze the market. So to put it into more perspective, so for instance here, let's put it like this, because a lot of people always try to ask maybe how to actually utilize it more. Now, in the markets, we obviously know, like, we trade, for us price action traders, obviously, we trade structure to structure, right? So for instance, if prices maybe were in a downtrend, broke below a support structure, made it into resistance, after the retest, we anticipate prices to sell until the next market structure. Same thing applies if prices were below, were held by resistance, broke above it, turned into support, we expect it to push all the way until the next market structure, right? It's no new news. We all know this as price action traders. Now, how do you know if maybe here prices will break? For instance, if prices here, they're approaching this resistance, right? Or they have reached this resistance. How do you know, will prices bounce or will prices break and keep on pushing higher, right? That's the $1 million question. That's the $1 million question. And being able to read the candlesticks will actually put you at an advantage of this, because obviously you'll actually be able to predict, or not just predict, but anticipate what's most likely going to happen here if you're able to read candlesticks properly, right? Now, here's the secret. It's all in the momentum. It's all in the candlestick anatomy, right? So for instance, if prices are approaching this structure here, maybe you took a buy and prices are approaching this resistance up here. If prices, you see, as they're approaching the resistance, they don't have that much momentum, then there's a big probability that they're not going to be able to break this structure and push higher, because they don't have momentum. If they don't have momentum, it means they don't have strength. So what does that mean? That means prices will have to retrace, go on a support structure somewhere to look for more buying pressure, to come back and try to break this structure if the market is in an uptrend. Okay, same applies if prices reach here and they have a very strong momentum, they have a very strong strength, volume, they're going to break it because there is a strong momentum, and they're obviously going to push higher, retest, and keep on pushing higher, right? Now, okay, so let's take an example of, for instance, here we had a resistance structure, obviously, no doubt. We had a resistance structure. Prices, as you can see here, prices were resisted here, fell back, looked for more resistance or more buying pressure, okay, on this structure here. As you can see, there's a resistance. And then after it got this resistance, support buying pressure here, you can see how its impulse move pushed that. You can see how strong that bullish move came. Gave a small correction, and then it showed continuation, that it's going to continue. This is a strong indication that the bullish pressure is still in play, and prices are easily going to break above the structure, in which it did. It broke above it, kept on pushing higher, gave us a retest on this structure that was broken, and then started pushing higher. We're approaching this resistance, but as you can see how prices are approaching this resistance, they are losing momentum. And then what happened once they reached that resistance structure? Prices fell off. Prices just started dropping. And you can almost predict what's going to happen because you can obviously see this. Prices are pushing higher, they're losing momentum. So most likely they're going to fall because they don't have strength. Here, prices started off strongly, heavy, strongly, and then just broke through that. So I know you all might have maybe a question like, what about this? Does this mean the strength was being lost? No. Look at the difference between this and this. This one right here shows a strong impulse move, and then this is a correction. Now, for those of you that have been in the trading industry for a while or have been in the channel for a while, you understand what when I always say this. The market moves in a behavioral pattern, right? So the market either moves in an impulse wave, retracement, and continuation, or it moves in an impulse move, correction, continuation. And this type of move mostly happens once the market gives a strong impulse move. The market will be having too much pressure to actually retrace, because if the market retraces, that means the prices are going lower. But because of this impulse pressure, prices won't retrace, they'll just correct. And then after a correction, prices will keep on pushing higher. And that's what happened here. Due to this strong bullish pressure, prices couldn't retrace. They just had to correct before they kept on pushing higher, right? So this is just in a market theory. So we'll talk about that in another video. So be sure to subscribe so that you won't miss out on the future content, and hit that bell notification so that you'll be notified when we do release that video. But currently, you can see that after that, prices did just push higher, break above the structure, and reached all the way until up there, retraced. And then you can see this is the difference is that here it started with a strong bullish move, and then it's kind of started losing its momentum here. You see, once it reached here, it has completely lost its momentum, and then it just retraced. It just kept on pushing lower. So you can see the difference between this move and this move right here. This is a correction. This is a loss of momentum. And if you are able to read candlesticks properly, you can obviously predict this is a correction, so there's probability prices will keep on pushing higher. But if you look at this, you see like, okay, prices are losing momentum. So there's the probability of a reversal. So that's how you can actually predict and actually anticipate market moves in the market, by just reading candlesticks. So if this video has been of help to you guys, please smash that like, share with a few friends that you believe the video will be of help to them. And don't forget to subscribe, turn on bell notification. And until then, I'll see you next time. Nothing but peace and love from this side.